The number one question I get asked all the time is how is the market? And I'm very happy to say I don't have to answer that today because I'm going to ask you from your lens as a lawyer, as somebody who sees a ton of deals happening. And I'll give you my context after based on 23, 24, two flat years going into 25, big changes coming. Government is going to change, rate cuts that are already happening right now. Not that anything is going to miraculously turn around, but how is the market right now from your lens?
How's the market today? So the market is actually so first off, the shit show continues. Let's start with the negative, and then I'll go into some of the positive. The shit show continues. The closings continue to happen apace. People are still closing on properties that actually took place in 2021. Dog crate condos are no longer valuable at all. People are just they're a dime a dozen. The rental market is falling out from everywhere, especially with the immigration numbers going down, collapsing. And I mean, it doesn't augur well for our overall economy. The tariffs now hang over our heads. Ontario relies heavily on manufacturing and exports to the United States. We have an incredibly weak dollar, and there's general malaise right now. I think that has set in amongst the business community, though things are not going in the right direction. At the same time, projects still don't pencil. The municipalities still haven't been beaten to a pulp. Vaughan has, but others have not, where they've started to lower development fees, which is going to be a necessary component in bringing new product to the market. And prices are still settling. When last we spoke, prices were at about $950 to $1,000 per square in most areas that have these new condo builds. You can now find prices routinely hovering at about 850, 850 to 900. So prices continue to go down. And remember that these prices are critical because the product that is closing had 1,600 a square. So what we're looking at is roughly half the values on resale product. And really, that's the crux of the problem. The crux of the problem is that equivalent resale product that's a year or two old is selling well below what new builds that are coming to the market are. And so in the new build space, that crisis continues. People are defaulting. They're defaulting regularly. It is just an event that happens all the time. They're doing the math and they're saying, thank you very much, we're going to walk away. And it makes for a sad state of affairs if you're dealing only with that segment. But of course, that segment, however large it is still a smaller subset of the overall market. And how's the overall market doing? Well, I think reality reality has a way of resetting the board. And reality is such that I think setting in is the understanding that even with lower interest rates, and interest rates may very well go lower, expected to, even with lower interest rates, we are not likely to see price increase. That is to say, we are back to market fundamentals. You can only deviate from market fundamentals for so long before ultimately you get back to standard. And we deviated for a long time. We've reverted. And now we're kind of staying flat,
Yeah.
meaning that pro formas are again important. It didn't matter what your pro forma said before. I mean, for the past 10 years, it didn't matter what it said. Cash flow negative, cash flow positive, double cash flow negative, if that's a thing. I don't know. Who cares? Because someone was going to buy it from you anyways. It was a leveraged product and you were getting 10% growth on leverage. Like, come on. Everyone's going to do it no matter what your cash flow position is. That's the essence of the bubble. But now that is no longer built into the expectations. Now we're reverting to a point where cash is king again, which it always has been because safe investors have always been there. And as a result, we're now at a point where you cannot escape bad investments. When I started my career, a mentor of mine, Mitch Goldhar, who builds out the smart centers, he has like a list of expressions. And one of his expressions is you can never escape land that you overpay for. And, the truth is that wasn't true for the past 7 years. You could easily escape it. You can no longer escape it. Bad investments now come back to bite you. Cash is king. Learning how these things work matter. And so it's nice that the fundamentals are back, but it's nice for another reason. It's nice because, frankly, our children, our kids, cannot afford life. They cannot afford life. Ontario is not a place where you can build your life because so much of your money goes to housing. I mean, that's the be all and end all of where we ended up as a result of the bubble. And we're reverting back to mean and flat growth in an era of inflation. mean, not much inflation, but still inflation means that every year these products become a bit more affordable and more affordable. So we are getting regularity back into our macro market, but we still have massive problems in the new build space. And because the 2021 product still has yet to really be delivered, and that 2021 and 2022 were the height, there's acute pain that's still ahead in many areas.
Yeah, so what we're gonna do is I want to talk about the resale market a little bit, and then I'm gonna go back to pre-con because the amount of questions I get on pre-con, there's this constant case study that comes to me, whether it's YouTube or somewhere else, and they're like, sure, they're doing the math of walking away. Back to what
Walking
you were
away, and
saying.
I do that math all the time.
And yeah, so I want to come back to that. But first, let me just start with the easier, or at least the healthier, which is the resale space. And here's what I want to, I guess, tell you what I've experienced in 2024, and I want to see if how that coincides with you. So in 24, I walked away from more condo deals than I have ever had in years prior, and a lot of that had to do with status certificates and just poorly managed buildings. And I know you do a lot of certificate reviews, and I cut my teeth on condos when I started my career, and I still do a lot of condos. And I can't. I've always been a proponent that in the next 5 years there's going to be a massive repricing of units just because of poor status
I agree with
certificates.
that.
Vancouver has already seen it. They're well ahead of us, especially with insurance costs there. So it's coming here, and I'm starting to notice it now. So we've walked away from a bunch of places, and the most concerning one of them has been recently, and I don't want to name any lenders, but a big bank, Canadian bank, is no longer lending on any status certificates that have lawsuits on them, even if they're immaterial. I had to walk away in December from a fantastic building, well respected, good, well run. They have a small lawsuit against the developer of the building that's going to be settled this year, and they're going to recoup 50 to 100% of the cost. We just don't know if it's 50 or 100. And
Well, let's not scare people because
yeah,
no lender will actually refuse to lend on a simple lawsuit. Like if it's a slip and fall that's an insured product, then the
yeah.
maximum risk that they're taking on is the heightened deductible. So they'll absolutely lend on that. Or a small claims court lawsuit that has a maximum quantum of 3,500. But where you're talking about something against the developer where it can expand, you are correct. Those become very problematic, particularly because CMHC is looking much more closely at those deals as well.
Yeah, so that's funny. It's interesting you bring that up. So I talked to my mortgage guy. He said this is not a building that's blacklisted on CMHC because there are a bunch of them that are. And the exposure to every unit holder was like, let's say 2 to 3 grand. And they had enough in the reserve to cover it. But even with that, the lender said, no, we're not going to touch it. So I found that interesting. So I want to know from you, from the lawyer's desk, you're seeing all these status certificates. Are you seeing more deals fall apart now? And are you seeing the quality of certificates being a little bit poorer than prior years, or is this just more my anecdotal experience?
That is one of the more interesting questions I've been asked this month. I'm asked quite a few questions like this, and that's actually a very insightful question because what you're harping on is actually harping in a good way, by the way, is actually a fundamental problem that we are going to be experiencing. The truth is that slapdab condos kind of came into their own about 2008, 2009 in Ontario, and then really kind of hit their stride in the teens, and certainly it didn't help when we were slapping up 500 condos at a time across the city. I have no doubt that the quality of construction was poor. Now, the reason that these timelines matter is because even if you do a piss poor job at construction, you generally don't see those defects for some years. That is to say, these things can be hidden. And poor construction really takes hold as a building hits 20 years, and we're starting to hit 20 years. I can't say that I'm seeing a discernible difference. We do a lot of status reviews every single
Yeah.
month. We do. And I can't say that I'm seeing a discernible difference in that. But I will say that we are starting to see, if I had to think about what might give rise to that problem and where it might be indicative of the fact that this is growing, I have seen ever greater amounts that are. I'm sorry, someone has just walked in. I apologize. I have seen ever greater amounts of increases that are routinely. Sorry, just 1 second, please. I apologize.
No,
I
no
have
worries. We
seen,
can edit
I
this
have
out.
seen ever greater amounts that are routinely embedded in reserve fund studies. So let me just back up and explain. Under the Ontario Condo Act, an engineer has to come through a condo every 3 years and do an assessment that lasts for 30 years for the capital needs of the condo. So the engineer comes through and says, all right, in year 5, the elevator is going to break down. In year 10, the roof needs to be replaced. In year 15, so on and so forth. And we need to have the following amount of money in our bank account. It was the case that we used to routinely see increases to the tune of 4%, 5% to the reserve fund portion of the condo fees. It is now much more common to see greater increases than that. Probably 8%, 9% year over year. And we see that routinely in condos. So it's not that condos that are properly managed, not properly constructed, properly managed. That is to say, the turnover meeting has happened, and then there's a serious engineer that comes in and a board that cares, will account for the capital needs through greater and greater condo fees. And this is something you and I can dialogue about because as an agent, you actually see these fees and you can speak to the fact that it always used to be a breaker when someone went above $1,000 in fees, but now you routinely see fees over $1,000 routinely. And that's directly because the condo increase amounts have been at 8, 9% compounded year over year for so many years. So we are definitely seeing the age of the buildings start to be reflected in the condo fees that are actually being charged. And I do agree with you. I think it's going to be a long-term problem, but no, I haven't seen a systemic problem such as I know exists in Vancouver as of yet. Vancouver has two problems. Vancouver has climate change problems to boot, which Ontario does not. We have flooding issues, that's true, but not like Vancouver. Vancouver has areas that are entirely uninsurable in some respects, and they're dealing with that. We don't have the insurability issues, but we do have piss poor construction. You know, when Concord started out, they did not have a quality. I'm not talking about modern Concord. Blessed be, they're good souls. But I'm talking about their first buildings. Boy, did they have problems. Boy, were some of those buildings shoddy. And the same can be said about a couple of other builders that I could name offhand who had substantial lawsuits. I mean, like the Concord one that I'm thinking of is 393 and 363 Front Street that had $8 million worth of litigation for their parking garage that was being argued about with Tarion for the better part of 10 years. On that was one of their first construction activities here in the province. It's very important that you be working with an agent that understands truly what a building is about because you're buying into a building's history, and part of its history is its construction. If someone cheaped out on cheap windows or anything else, it will come back to bite you.
Yeah, this is so this is very interesting. What the reason we're backing out is I feel that we might be early. So you know how some people can see a trend and they're just
Yeah.
early in the trend and they're prematurely backing out and it's not going to crystallize for another 2, 3 years. And that's the problem with me because I'm watching this like a hawk because I have vested interest in condos and stuff. Like I'll give you a couple of examples. We just walked away from a building that had $10 million special assessment for windows. It's an older building, but the bigger question is you knew windows are coming up.
Right.
Why
Why
did
is
you
there a
not?
special assessment?
Why is there a
Yeah.
special window like on windows? Like understandably, if something happened, like a balcony membrane or something failed that shouldn't have failed, fine. But on windows, so that's what kind of worries me, right? We had another one where they, back in the Kitec days, they used some epoxy membrane on risers. It's like 2 million bucks, and to rip it all out, okay, that's fine. The technology failed. You got to rip it out. You rated the reserve fund. Now you're starting. Now you have a 15 to 20-year-old building with zero in the reserve and low maintenance fee increases because everybody wants to keep them low and they're basically exposed. And then, so things like that, I can't in good faith put a client into that, even if they like the unit and
You
building.
know what? You know what a sign is as well. Just when you're looking,
Yeah.
if someone changes management companies,
Big time. Huge.
it's a huge problem because what's happened behind the scenes is there has been a fundamental disagreement. Now, sometimes it's just like the employee you gave me is involved in fraud and everything else. You kind of hope it's like that because the bigger issue is the engineer that you hired, you've been in bed with. This is always what happens. The engineer you hired, you've been in bed with. You screwed us. Now this problem has come about. You hire a new management company, they bring in a new engineer. And do you know what? If you hire a new management company, Dollars to donuts, they're going to hire a different engineering company to do the reserve fund study. And that engineer then has every incentive to point out all the flaws of the previous engineer so that they can say, because they want the contract going forward for many, many years. So what they're going to do is they're going to do a true analysis and they're going to say, this person missed this and this and this and this, and we need to increase here. And what do you want from me? You use that guy. You shouldn't have used that guy. I'm the real deal and I'm telling you what you need to bring in. And I see that over and over and over again. So when there's a change of management company, there's often a change of engineering firm, and the change of engineering firm is the signal to allow for the stuff that has been pent up to be released. Because if you think about it, and most people don't really give a lot of credence to this, the engineers are not like unaffiliated to the management company. After all, they owe the management company their allegiance and their contract year over year. And the last thing they want to do is report bad news because then the management company has to spend time talking to the unit owners about how much money they have to increase. The best thing for them to do is to say, everything's fine. We're going to increase by 5% per year. Done, finished, and let's move on with our lives. Delivering bad news takes, in Yiddish, we call it beit seam. I'll let you figure out what it is. And that's what it takes. It takes the cojones. You got to go forward and you got to say, listen, guys, you got to address this. And many, many, many don't. And because they don't, it often comes to a crescendo. And then the management is like, we relied on the engineer, and everyone said, screw you. Why did you use that engineer? You change the management company, you change the engineering company, boom, fees go up. Everyone sits there and says, well, you shouldn't have used those guys. And all of that comes down on the purchaser. So that is a warning sign for sure.
You're speaking my language. So I'm the type of guy I call the reserve fund engineers on the units I'm buying. Like I go to that level of I find who it is and I'll find the prior ones if they've changed and I'm like, why did you lose the contract? Some will be reluctant to speak, but a lot of them will open up. I will tell you a tip right now. I have this book. It's called, I don't know if you can see it, and shout out to Sally. So
Okay. Yeah.
Condo Questions and Answers. So this is the engineer behind the Condo Act that she developed, like I think, or helped develop like 20 or 30 years ago. She is part of a firm called Synergy Partners. If your condo, the engineer's synergy, you can pretty much rest assured you're in good hands. It's like the Mercedes-Benz, it's like the Tridells of, constructions and stuff. Great, great name. But this is very big. Like people completely miss this. And I think that's basically who you have to talk to, aside from, the property manager and stuff.
I agree with you. The quality of your engineering firm matters a great deal. Like if you have pension that's on the line, pension is just okay. Like they don't do a lot of them because they're mainly commercial. But just as an example, pension is just way too big to fuck up.
Yeah.
Just way too big. They're not going to stick their neck out for you for a diffy little contract or even a big contract. They're just too big. They have too many responsibilities. The bigger you are, the more you are incentivized to tell the truth as opposed to chase the smaller dollars. If you are a small engineering firm, or heaven forbid, a single engineer, your livelihood rests on these contracts.
Yeah.
And they're not all the same, is the point.
Yeah, yeah. Okay, that's great. I'm glad I'm not the only one noticing this. So let's switch gears to pre-con because I think this is the one where a lot of people have questions, and I've had a couple of clients, similar situations, slightly different angles. Um, sorry, not clients.
Hey,
These are,
before we switch back, can I just mention
yeah,
one thing?
yeah. Go ahead.
Everyone who actually gets a status certificate in Ontario should be aware that the status certificate contains only a reserve fund summary, but everyone is entitled to request a copy of the reserve fund itself, which is 150 pages or so that detail what's going on at the condo. And so if you have concerns, you are able to go behind the numbers of the actual increase. Lawyers usually do not, but you can request it and you can go through that with a fine-tooth comb. I just want to throw that out there
Yeah,
before we move on.
yeah. That's a great point. Yeah, no, that's excellent. Pre-construction. So you kind of pointed out earlier, 21 and 20 is when the big price hikes were, and those are completing or going to be completing soon. So I don't have the number off the top of my head. It's a reliable number in terms of how many completions we have, but we have a lot. A lot are completing in 25 and in 26. And these are going to be the high priced ones. So there are a lot of issues. I'm going to rattle off a few of them. And then you can kind of maybe give me your thoughts on what if they're again big enough in your mind or if they're kind of outliers. And then I want to talk about the most common case scenario people bring to me, and then they're asking for a solution. And I think the solutions are very simple. It's just a math equation with two solutions.
That's right. And I'll talk about the math equation because I do that every single day with
Yeah.
clients.
Yeah, and I think people are hopeful that there's something else, but there isn't, right? Like the law here is very straightforward. So we know that people are losing their shirts in pre-construction. The one thing that's very interesting, and I think you might have said it late last year, is that let's say you bought a unit for $800,000, whatever the unit is downtown Toronto, and let's say right now on the assignment market, that unit is trading at 650, so substantially less. What I'm finding out now is that even if 80, 90% of the building is willing to close, willing and able, and have the financial means to do it, they're now facing a different problem because the banks are looking at what's traded in the secondary market and assignments, and they're saying, excuse me, I pre-approved you at 800,000 for this unit. It is now worth 650. So you now have to come up with 150,000 additional money for you to close, for me to give you a mortgage, because they don't have these blanket
That's
appraisals.
right.
Maybe. So is
That's right.
this a big enough issue right now with
It's a huge
closings?
issue in the new construction space. And if you think about it, and this is the way I say it to clients, because I have this discussion every single day. Every single day, someone comes in and says, it's been appraised at X, and now I have to put in an extra $150,000. What do I do? And the first thing you have to explain to them is that it's not the appraisal that's crystallizing their loss. Their loss is crystallized because they signed an agreement of purchase and sale that ultimately calls for them to pay this. The question is, who is the loss going to be payable to? Because you can either make that loss happen to the builder in the form of a non-closure and then have their lawsuit, or you can make the loss happen to the bank insofar as you go forward, put down your extra money on the deal, get a bank mortgage, and then can't sustain that bank mortgage, and then it's sold, and you still end up in the same position. That is to say, the value is the value. They're going to resell for the value, whether it's you reselling or through a power of sale process or through a breach process. It's all going to be resold for the same price. So really what we're talking about is not how do I avoid the inevitable, but who am I going to be in hock to because of the inevitable? And it's critical that you get your head around that mental space. And a good portion of that is due to the appraisal misevaluations, which are taking place all the time. There was a period of time which was actually, frankly, a bit corrupt in Ontario, where places, let's just use RBC as an example, but not because it's RBC. Yes, it might be RBC, but I'm not going to say RBC, where RBC provided the construction financing to a builder and then provided blanket mortgages at the stated purchase price to the purchasers in the understanding, although technically no one will admit to this and no one has tracked this down and no one can prove it, but P.S. it did happen, in the understanding that having 100 people owe RBC is better than having the builder owe RBC because they'll get back more money from 100 people than they will from the builder if it goes insolvent. So let's go ahead, appraise the value at the stated purchase price, and there we go. But that was actually when prices were still much higher than they are today. You do not see blanket appraisals any longer in all but exceptional instances, particularly for the 2021-2022 product, because they know how offside it is with CMHC, who will ultimately be on the hook if they do this. And accordingly, we're no longer seeing that sort of shenanigans and hanky-panky. Also because enough of us have alerted the media to kind of be on the lookout for these things, that the banks are not playing that game. So the vast majority of people are in a position where they are told their property is worth $150,000, $200,000 less, and then they come to a lawyer and they say, or yourself, and they say, what do I do? And you'll permit me, because I'm assuming your question is going to go into what do you do? What's the math? And the math is very simple. You pull out an Excel spreadsheet and you say, look, here's what it is. If you choose to close this property, then you have to put it, you save your deposit, that's true, but it doesn't matter because the property value is whatever it is. You have to account for your adjustments. You have to account for your land transfer tax. You have to adjust for your 6-month holding cost on a private mortgage of, say, 8% plus 2% lender fee. And then you have to account for your commissions on sale of 5%. And you have to wrap all of that in to that versus walking away from the deal, in which case your deposits that you've already paid are part of the loss, plus whatever the builder's additional loss is. But that builder, when they resell, will have someone else absorb the land transfer tax and the adjustment costs and everything else that go into it. And when you do out the math on something that's, say, 200 underwater on a $1 million purchase, you generally find that there is a net savings if you just do out them. I'm not going to go out through the math with you, but just generally of $100,000 to $150,000 simply walking away as opposed to closing. You have to be open to litigation. And that in itself is a problem because so many people signed with their parents and signed with their girlfriends and everything else. And as a result, the litigation is going to affect more than just them. And there are strategies that we suggest where we say, listen, go to the builder, cry, explain that this is your first home, tell them about the fact that you were an injured Vietnam vet and that, like you've never owned a property and a wolf stole your children. Like, engender the pity for sure. But at the end of the day, if it does come to this, let's put up a defense, and that defense will not be that you were objectively wrong, because you were objectively wrong, but rather we'll put up a defense to the damage claim. Hopefully, we can make enough of a muck that they settle, and when we settle, it's going to simply be for less money than had we closed and then sold this for market value, crystallizing our loss then. And that's the math that you have to bring people through every single day as they kind of come to terms. Some people are really litigation adverse and they just want to take their loss and they don't want to they want the security. And that's fine. That's fine. This isn't a business for some people. For some people, this is a house and they just need to sleep comfortably, especially if their wife or their son or their daughter or their parents are on the hook. But for most, it's a business decision and many people are choosing to walk away accordingly.
Yeah, this is you exactly. So this always made sense to me. And not to say walking away is the right thing to do, but as the most common example, I'll tell you, and you already answered the question. I bought for 800. I put $160,000 worth of deposits. The place is now worth, if you're lucky, maybe 700. Maybe it's worth 650. So the deposit buffer covers, let's say, the losses, not accounting for all the small things. But now they're in occupancy, so they're paying $5,000 a month. They can't rent the place out until they get it, until it closes, whatever the case may be. And they're bleeding. And look, I can't keep doing this. So what should I do? And the way I see it is there are two options. So it's really three options. You can walk away now, you can close and walk away. Or the other option is if you can cash flow it, you suffer for the next 5 to 10 years or however long it's going to take for it to not be in this position. And that's it. But really, there's nothing, one way, they're
That's,
all,
there is one thing I'm going to tell you that I don't know you've ever thought about, which is this discussion should be made before occupancy. Do not make this decision at final closing because there's an HST rebate to consider. And if someone goes into those units and then lives in those units and then defaults, then the new purchaser cannot claim the HST rebate
it's a
because
great
they're not
point.
the first occupier of the unit. So there's $24,000 that's often in play by actually making this discussion early and giving the builder the chance to not have anyone occupy the premise and ultimately resell.
So if somebody has started paying occupancy, they just did their PDI, they're paying the occupancy fee, but nobody has actually
Then
occupied.
it's fine.
Okay,
Then
as
then
long
it's
as
fine.
nobody's living in it.
Correct. But you can't guarantee that. I'm saying to you, fundamentally, people try to, if they're bleeding, they try to get someone in there immediately. And if they get someone in there, then you can't sell to another end
Got
user
it.
on final closing because you're going to be denied the HST rebate. So this is a discussion that really should be had before occupancy.
Got it. Okay. So let me just I want to ask on top of this. So let's say somebody is like, I'm gonna walk away from this. And let's say their case is not super severe where they bought for 800, but it's worth 500, where there's gonna be a lawsuit for the difference and all that stuff. Let's say it's 800, the builder can probably sell it for 650. They've given 160 grand worth of deposit. So it's kind of close. So for a person like this, if they approach, let's say they engage a lawyer and they're like, I'm gonna approach the builder and say I'm not gonna keep paying the occupancy fee. In terms of a timeline and in terms of next sequence of events, I'm assuming, okay, then the rigmarole starts with the legal teams, and then they have to put it up for sale reasonably quickly because they have to make an attempt to try to sell it, right? Because you can't.
Legally, they don't have to put it up for
Oh,
sale. They are
okay.
allowed to choose their method of dealing with damages. There is actually case law on someone who has held onto a golf course for a full year in the understanding that they could better it and increase the cash flow, and increasing the cash flow would be better off. And the court said that's perfectly legal. You do not have an obligation to get it right back on the market. Having said that, I can't see a scenario where it's not advantageous to everyone to get it right on the market. And so, for the purposes of new construction, for all intents and purposes, I'm arguing the law, but practically, yeah, you should be getting it right on the market.
Okay, so then this person engages a lawyer, they go to the builder, I'm walking away. Builder does their thing. Okay, I'm gonna take over the unit. I'm gonna put it up for 650. I'm gonna try to sell it. Market slow, maybe it takes 3 to 6 months to sell. And then at that point, they have now crystallized everything is they know exactly who's owed what. And then at that point, is it some like a settlement or is it depends on the amount they're gonna pursue legal
So
or
generally what they do, first of all, they can pursue law before their damages are crystallized. Okay,
okay.
you can sue someone and you can just put damages in abeyance. Perfectly legal. You can get your judgment. Damages to be determined. No problem. Most people choose to put it off because they have 2 years to sue. And generally, most builders will look to see if you have assets on the system to review and whether or not you're worth pursuing. Um, It's illegal, by the way, for anyone, yourself, myself as well, to advise people to dispense with their assets. There's something called the Creditor Protection Act. A lawyer cannot advise it, and we cannot say, wink, wink, you should be dispensing with your assets. Like, there's a Creditor Protection Act, so just be aware. Like, that's not what I'm getting at. I'm getting at the fact that you're a professional, I'm a professional. You are not allowed to tell people to shelter their assets. You can't do that. It's not allowed. Um, so they'll take a look to see if you have assets. If you have assets, they may choose to sue you, or they may choose to just walk away and say this isn't worth our time because our damages aren't that severe. There we go. They make their internal decision. A lot of people say from a business perspective, we don't want to do this. I haven't seen Tridel sue anyone yet. A lot of people, I'm sure, have walked away from Tridel product. Though, in fairness, Tridel product has always been better priced. Like they never engaged in the hubris that others did. Like, yeah, I purchased the Tridel product at the height. I paid 1,050 a square for Westerly too, and that was in 2021. That's when product was going at 16, 1,700 a square, right? Like to some degree, they haven't. And Minto too, and Menkes, like some of the big builders never really massively overpriced their product. Like, don't get me wrong, in prestige locations, when it was Allied building out on King Street, like yeah, but if it was just a normal condo going up, they had the advantage of having held on to land from a long period of time. And they had different construction costs. They usually didn't put in the same math. Having said that, the smaller guys, particularly those people who are being hounded by their banks for paybacks, they do routinely go after people. I know people who have launched 10, 15, 20 lawsuits against people in a single day. Those people sometimes don't even care if you have assets. We'll discover it through the litigation process. Everyone's different when it comes to this, and them and their counsel will have to determine what their next steps are.
Shout out to Westerly too. I know so many people that have bought in there. It's incredible. It seems to be the common thread here. It's a lot of intelligent people that I know that have bought in there. So for whatever that's worth. Okay. So on the flip side of this, I do have one other question that's completely different. If you're in a good cash position as an owner of a pre-con that you overpaid for or overpaid for by a little bit, when occupancy starts, typically that process, it could be months, a couple of months, few months, maybe over 6 months, and people don't want to pay that interest to the builder for the construction loan. Have you seen examples where somebody is willing to just pay the whole thing outright
Oh, I see
before
that all
that?
the time, particularly in the Chinese community. That's very,
Yeah,
very, very common in the Chinese community in Markham and everywhere else.
yeah.
No, I see that all the time. Now, two things to mention. First off, I don't suggest you do that. The builder has an obligation to accept that if you offer that at the time you sign your contract,
Oh, okay.
not at the. That's what the Condo Act says. Having said that, they usually accept it anyways. They'll usually accept those monies. Um, there's a couple of reasons we don't suggest doing that, and it's not good practice. First, you're giving up your leverage. If you give someone all the money, then you have nothing more to lie back on when it comes time to close. I don't like that. I don't particularly advise you to do that. But secondly, the interest rate right now is 7.24% as of January 1st. That's what the one-year bank act is. Fine. Okay, 7.24% is a lot. But you can make, if you properly invest in, say, an S&P EFT, you can make 5, maybe 6% on the year with that same cash. Now, granted, you have to pay tax on it, not if you get it through a TFSA. I'm not saying it's equivalent, but it's certainly not 7.24%. You're going to be getting back a significant portion of that. You're looking at a minor amount. So, and it's usually only for a couple of months. So, all things being equal, just buck up and keep the money so that you have your firepower effectively, so that the builder isn't just sitting on all your cash. I mean, after all, think about this. If you default because you don't come up, if there's a problem on the day of closing and they have all of your money, technically they're allowed to just say, screw you, you didn't meet our 5 o'clock deadline, there we go. Whereas if you haven't given all your money, I could say, listen, just give me one day and I'll give you the money. And then they're much more likely to say yes. It's easier. You have more negotiation leverage if you don't give the builder all your money.
Yeah, makes sense. I agree with you. Just some people are treating it, like you said, like a business, and they're looking at the pennies and the cents and where they
Which
can
makes sense.
reallocate.
Which makes sense.
Yeah,
Like for some people, sure, not a problem. But then they're going to come to, the problem with being a lawyer, the problem with being an agent and the problem with being a lawyer is that we're opposite sides of the same coin. The glint in your eye is for business opportunity. The glint in my eye is for risk. And we are asking our clients to combine those two things. right? And so when you come to a lawyer and ask that, what you're saying to me is, what are my risks in doing it? Whereas when they say it to you, what they're saying is, there's financial opportunity here in doing this. And it's always the case that if you just listen to a lawyer, if you just listen to an agent, you're probably not well off. Like all things, it's better when you combine knowledge, process it, and make your own decisions.
Right on. The last thing I was wondering from you, and again, I don't know if you've ever seen it, but have you seen a project in the GTA or Toronto in particular where uh, the risk of walking away is so high that it would be something where we don't have precedent in terms of what to do? Does the Condo Corp even get formed? Like, how would that work?
No, it
Where
hasn't
it's
happened yet. Ron Butler is on that one. He is waiting. He is waiting. I swear to you, he's hovering around certain condos that he's like, I'm waiting for that first one to drop. I've heard him say it so many times over dinner that he is waiting for the first one not to close. He believes that that will happen. He does believe it will happen, but it's a bit beyond my pay grade. I can't
yeah,
speak. I think that's more of a Dan Falk question. That's more of a Jeremiah Seamus. That's more of a Ron Butler question. That's more of a systemically, is someone in trouble such that they cannot close because there's so few people who are because they're so upside down on product. And even if that has happened, and I've known of a couple of internal cases, other people have bought out positions so far. But it's widely expected amongst the colleagues that I respect that that will eventually happen, especially as the prices go higher and higher as we approach 2027. And all of us are waiting for that because the moment that happens, I think that's a dam that breaks. I think that that brings a new reality to our market, which makes lenders way more wary, up their lending standards, and in turn produce downward pressure on purchasers who are seeking to close, which then becomes a circular effect.
yeah. Wow. Well, on that note, hey, when people ask me how I feel about the market, I feel cautiously optimistic, but that's just me. Maybe just that's
No,
just
I do
an
too. It's because we chose to speak about it's because we chose to speak about new build construction.
yeah,
Remember, that's a small subset of the larger market, and the larger market is actually a healthy market for our young Canadians. Like we finally have something that is adjusted where we're not slamming through, where people can adjust, where people can say, I'm making a measured decision, where all money doesn't have to flow into real estate. You know,
yeah,
like Canada's innovation economy has withered away to nothing because every single cent we've had has gone into fucking condos, right? As opposed to business, as
it's so
opposed to
true.
hiring people and doing this type of stuff. This is a healthy thing. This is a healthy adjustment. It's painful, but it's healthy. Where there was acute pain is in that smaller subset, and that's what we chose to focus our discussion on today. So please don't think that that's indicative of the larger market, but it is certainly indicative of the people who are going through the pain cycle that they're going through, and that I will go through myself as Westerly completes next year.
Hey, I'm glad you pointed it out because as you know, the negative news gets all the clicks, aka Twitter. But I feel like 2024, although we had a record low year in terms of transaction volume, it's been super slow. Like, I mean, we had, I think, just over 60,000 closings or firm deals, and I think we usually hover around 80 to 100,000. And then 2025, we're starting out with 50% more active inventory. A lot of that is in condos. But look, I have listings coming out this month, and surprisingly, I'm getting some action. So it's nice to see. And I think
It's
it's
been a very
because,
busy January. It's been a
yeah,
very busy January. So, like, for what the stats aren't out yet, but it's been very, very busy.
oh, good to hear. I'm glad to hear that because again, I thought like I'm almost not that I'm nervous. I don't like sticking my neck out too much, saying, "Oh my God," it's because I just don't know. But anecdotally, it's been halfway decent. Um, so that's awesome, and I appreciate your point of view. It's always very refreshing. I think we're gonna have to do this again in January of next year, and we'll see how this whole thing turns out.
Look forward to it, Vass. Thanks for the opportunity.
Awesome. Thank you.